investing is it's as if you're planting a fruit tree. But someday in the not too distant future, you can eat fruit from that tree. The best time was yesterday. And the next best time is today. You don't have to invest R1 million to see meaningful return.
Welcome to Breaking Down Markets. This is the series where we break down complex financial matters. We make them simple, relevant, and accessible. In our first episode, we looked at the JSE and the role it has in our economy. Today, we'll be breaking down one of the most talked about and sometimes mostly misunderstood financial concept, which is investing. My name is Sithole, and today I am joined by Muhammed Wagley, Portfolio Manager at Sasfin. Well, as you know, this show is all about you. So if you have any financial concept that you want us to break down, definitely leave a comment in our comment section and we will definitely tackle that. Muhammad, thank you so much for joining us today. Truly appreciate it. But I think first of all, I'm going to ask you, how have you been?
Thanks, Sally. So such a pleasure to be on. Thank you for sharing your platform with me to talk about a concept that I think is quite important. But I think first things first, all good on my end. Can't complain. The sun is out. I'm happy.
Nah, I'm glad. Okay, so now getting right into it. The word investing has been thrown around a lot of times, right? But what is it really? Like, what is investing if you have to put it in simple terms?
I think as simply put as I can, it is making your money work for you. Really when you think about investing, and I think one has to think about it within the context of savings, savings are basically a safety net, right? In case of emergency, you've got something to help you, whereas investing is a little bit of sacrifice now to see things grow later down the line and ultimately give you the opportunity and ability to choose, give you that option of choice. And I think that's really the important concept. Investing, I think, in many ways on media and things like that sounds very glamorous, and we're almost led to believe, that there's going to be some type of instant gratification, but it's a slow burner. I think the most important word when it comes to investing is consistency, and that's kind of sort of the context that one needs to be looking at investing in. It's mindset, it's discipline. Those are sort of the important facets. It's not necessarily that you got to find the company that nobody's ever heard of. It's that you can, with consistency, put funds away every single month. And you don't need to be a millionaire for that. It's disposable income.
Okay. I want us to stay on that, but break it down even more. What is the difference of saving, investing, and just like putting money away? Like if you have to like really give us a difference between those two,
Sure.
how would you really,
So I would say saving is an absolute necessity. This is money that you need in instances where you can't sort of predict. There is, I suppose, a downside risk that you could say, one needs to have X amount of cash. I see loads of numbers floated about people say 3 months worth of salary, just in case, something happens. So from that perspective, your savings aren't necessarily going to grow, but they're there just in case you need them. Whereas investing is really the analogy that I like best. It's as if you're planting a fruit tree, and it's going to take a lot of care. It's going to take a lot of effort, lots of maintenance. But someday in the not too distant future, you can eat fruit from that tree. It's not going to be today. It's probably not going to be tomorrow, but it'll take a bit of time. If you do all the right things, it will yield some fruit and you can benefit from that. And investing is more or less the same in that respect.
Okay. So now, how do we actually get started? Because growing up as a young girl, I've always been told, you need to start investing, you need to start looking into your future. But like, where do we actually start? Where do we go?
Well, I think the first thing we need to identify is what can we invest in? There's a whole bunch of different financial instruments that one can invest in. And then there are sort of the more intangible things that one can invest in as well. I think just before we started this conversation, we were talking about, further studies and things like that. That in itself is also an investment. It comes back to that thing I was saying a little earlier, just about sacrificing today for that long-term gain. So to answer your question very directly, there's a whole bunch of asset classes that one can invest in. And sticking with my food analogy, it's like as if you go to a buffet, you'd like like a balanced diet, you'd like a balanced plate on, but you've got to get a little bit of everything. If you've just got your equities, which I could say is really the meat of your plate, it's very aggressive, but may not be the right sort of investment for you. So I think the first question that one needs to answer when they think about investing is, what is the purpose of the investment? Why am I doing this? Often enough, I will hear that, look, I'm investing, so I can help my retirement or move forward my retirement. And that is, a reason. But often enough, that's, I would say, even a little bit too vague. Well, what about your future planning? What about cars that you may want to buy? What about, your kids may want to get married? You may want to get married. These may be things that you want to fund in. The end goal of your investment objective is, I think, the biggest determining factor in what you should invest. What sort of fills your plate, at the buffet, the mix of your asset classes. So that's really the key thing. The first question we always have to answer is, why? Why am I investing?
I like that you're talking about the buffet, so I'm gonna keep it there. Sometimes when I'm at Bry's with friends, we talk about investing, but there's a myth that says that investing is for the wealthy. So when do I actually start? When I'm in high school, when I'm in varsity, or when I start working, or when I get my first million? When do I actually
Well,
start?
so there's that very famous quote. I think it's attributed to Warren Buffett. The best time was yesterday, and the next best time is today.
Okay.
Don't feel like you've missed out just because you've not done so before. Again, coming back to what I was saying, the main point is the consistency. I always tell people that you don't have to invest R1 million to see meaningful return. What you should be doing is investing that part of your disposable income, which you can do without sort of impacting your lifestyle. And you need to be doing that on a monthly basis. If that is 10 Rand, so be it. There's no sort of limit to this. There are platforms like Easy Equities, that can accommodate for such trades. So from that perspective, I think never exclude yourself on the basis of, I don't have enough money. It's the principle that matters more. And I'm sure we'll touch on this later, but when you think of things like compounding, you may start with a nominal amount that isn't too big, but if you're consistent with it, it grows. I was doing a bit of an exercise. I've recently just become a godfather. My best friend has had a child.
Okay,
And
congratulations.
thank you very much. Very proud. And, I've now been thinking about things I've never had to think about before. And one of those was, future planning for the baby. And so we've been looking into tax-free savings accounts and things like that. And we've done some sort of projections, if by the time she's 21, we do the 36K every single month without any growth at all, that'll be worth about 756,000 Rand. And if, we invest in some passive funds that are diversified and tend to grow, things like the S&P 500, even the all share here in the JSE would fit the bill there. That would be worth well over R1 million, probably closer to 1.5 million. Now, obviously, that is taking out inflation, which is something that you absolutely have to consider. But, it's like simple things like that, which are accessible to the general sort of public, can be done. And it's not really rocket science. I think often enough, we mix those two things. Investing is generally simple. It doesn't have to be super complicated. And there are loads of people out there, hedge fund managers and the like, that do make like loads of money, doing things that are super complex. But the vast majority of people that are doing well are investing in things like passive funds, unit trusts, things that are super accessible. So it is definitely not rocket science, and it is sort of accessible to everyone. We shouldn't limit ourselves, exclude ourselves on the basis of, I don't have enough money.
Okay, I like the fact that we've already unpacked what investing is, but now let's talk about the main instruments of investing, right? I'm taking away a little bit of 100 Rand every single month, putting away, but what am I actually putting away into? What are some of the investment instruments that are out there that I can actually put my money in?
So I would say, Sally, for someone with yourself within a very long sort of horizon, investment horizon, in terms of, you've got loads of time in the working world left, so far away from retirement, I would assume, and you let me know if I'm wrong, but, you've got a relatively higher risk appetite than somebody who's a little bit older, and from that perspective, and I think the, risk is a key word here.
Okay, hold on. What is risk appetite?
Well, okay, so it's a good question. Let's start there. I always look at it like this. how does one feel when I gain an extra rand relative to how I would feel if I lose an extra rand? If that feeling of losing the rand really doesn't sit with me and I feel like, my life has really been negatively impacted by this, then generally speaking, I probably do not have the biggest appetite for risk. Very practically, what that means is that if I put down 100 rand in an equity, I suppose we'll come back to that a little bit later, but if I put 100 rand today into an equity and tomorrow it was worth 90 rand, that's probably not the best investment for me because I don't have a high risk appetite. However, if I was the type of person that didn't really look at those short-term fluctuations and I really wanted to see growth, it wouldn't bother me that today it was worth 90 rand if this was a company I liked and I had done my homework, because ultimately my view is that, a year from now this will be worth 120 rand or what have you. So one has to always look at it with that concept, within that context. The idea is utility. So basically, how much happiness, I suppose you could say, does one derive, from one of these events happening? So when I say risk appetite, I'm always thinking about, well, how does it impact you if you were to gain that rand or if you were to lose that rand? So coming back to what I had mentioned in relation to you about risk appetite, if, for example, that 100 rand you invested is worth 90 rand today, your investment horizon is long enough where you can stomach that. Maybe a year later it'll be back at 100 rand, but you're not sort of not eating because of that, if that makes sense. Your lifestyle doesn't take any hits in that respect. So that's really what I'm making reference to when I say risk appetite. So in this scenario, I would be looking at investing in equities, and this is the thing. It's very easy for me to say that, I sit and I look at screens the whole day. We're looking at different companies, but most others are not doing this. They've got their own day jobs and they don't have enough time to be able to be looking at separate companies each and every day. But there is a way to get a diversified exposure to the entire market where you don't have to, be looking and paying attention to companies every day. And that can be done through your unit trusts, your ETFs, things like that. Something like your top 40 ETF, which gives you exposure to the 40 biggest companies on the JSE. That can be easily found. I think Satrix does a product in relation to that. They do something similar with the American market, the European market. I would say to sort of dip my toes in, that is where I would start, because, coming back to what I mentioned about the tree, you've got to maintain it, you've got to care for it. Otherwise, it's not necessarily going to yield fruit. And this is not too different. You can't just put money down in an investment and just assume that it's going to go up. You have to be reviewing, seeing if you're in the right place, seeing if your funds have the right sort of risk allocation, i.e. you've not put too much money in things that are very relatively risky. If I was, let's say, for example, someone who was, let's say, in my 60s and I needed to be drawing off my investments, i.e. I need an income because, I've stopped working and I need to sort of live off these investments. I can't afford that in those investments to drop sort of by 10% in the same way that you can, and if I've got a lot of equity in that instance, I've got to do a bit of trimming here and there and move into something that's a bit safer.
Okay. You mentioned ETFs, you mentioned unit trust. What are the difference between that? Now also let's add in bonds to the mix as well.
Sure.
What are the difference?
Okay, so let me start with bonds, because I think that one is like a lot more different than the others. I think first and foremost, it's a much safer investment. Essentially, what's happening is you are loaning funds to a company or a government, and in return, these companies or the government gives you sort of interest in return for that. That is what a bond is in effect. It is viewed.
So I can do it.
Anyone can do it.
So I put money, loaning my money to companies
or the government. So
Okay.
generally these bonds are government bonds. That's generally how they sort of go. Those are probably the safest ones. And in return for that, for being able to use those funds, they give you a little something, which is your interest payment, basically. I think that's probably the most simple way that one can look at it. And because it's backed by something like, generally it'll be a massive company or a government, so it's relatively risk-free. The risk that you bear is, okay, if the government goes under, that bond of mine might be in trouble. But we almost look at that as if it's risk-free. So if you had to look at sort of that risk-reward spectrum, you would expect a lower return from your bonds, but you're also taking lower risk, So relative to equities, which I mentioned earlier, you are taking a lot more risk. And in that respect, let's say you buy some shares of let's say MTN, for example, just arbitrarily out of nowhere, your risk is that MTN, let's say, stops making money or goes under, that money that you invested will sort of go to zero. Whereas within the context of the bonds, the risk that you bear is really the government in its entirety. So from that perspective, it is a lot less risky. But again, the trade-off is there's a lower return. So that's something to keep in mind.
So this bond, is it different from the bond that people have with their houses?
It's very much the same in
Okay.
that, like, I suppose the counterparty is just then on the other side.
Okay.
So that's really what you're thinking of there. And then you mentioned
Unit trust.
unit trusts and ETFs. I think for all intents and purposes, I would urge the layman to kind of view them as more or less the same thing. Essentially, what it is you're buying, instead of one share, you're getting a whole basket of goods. You're getting the whole buffet basically on your plate. So the ones that I like to look at are sort of those ETFs that give me offshore exposure, maybe to the US market, to the European market. You can get access to India, China, really wherever you want. You have access to it. In fact, the South African sort of all share index, which you can get sort of ETFs on, has done phenomenally well as well. So there's lots of products like that where one can buy one of these without having to pick, between millions of thousands rather of different stocks. There's a product that just, let's say, tracks the top 40 companies in South Africa, and you can just get one of those. So, and instead of having a whole bunch of different shares, you've got sort of one product that gives you exposure to all of them. Basket of goods is what I would say.
So a great friend of mine gave me this example, but you'll tell me if this is a great example or not, because you're the expert. So they said ETFs is like a bowl of sweets, right? The bowl is the ETF, and the bowl is like the platform, and then the sweets are the actual companies that you get to buy shares.
Yeah, licorice,
right?
all sorts.
Licorice,
Yeah.
all sorts of sweets. So with
Okay.
my 100 rand, that means if there are 10
Yeah.
sweets in there, that means a share of my 100 rand was
100%.
divided in those sweets. So was that a great example?
Absolutely. I think I'll probably keep that one. So,
Okay.
so yeah, I think very practically, let's say you invest 40 Rand in the top 40 companies on the JSE, the top 40 ETF, 1 Rand will be exposed to Richemont, 1 Rand will be exposed to your MTN, your Naspers, so on and so forth. So that's actually quite a nice picture that you paint there.
Okay. So now moving on, when we are investing, like you mentioned earlier, we are investing because we have a certain goal. You spoke about, our academics, for example, maybe for retirement. But what are the most common objectives that people have when they invest that you have seen?
I think most commonly it's just about growth. It's about wanting to do better, having a little bit more freedom in your retirement, a bit more sort of dignity in that part of your life. It's not really often where clients do come to me and they're hoping to sort of double their wealth in a couple of years or whatever. That does happen. It's generally sort of younger people, but that's not necessarily going to happen within the context of equity. That's a little bit of a pipe dream. This is a slow burner. These things take time. If you're doing 10% a year on your investments, in 7.2 years, because of the compounding effect, you'll actually double up. And I think that's, a great outcome to look at. But coming back to your question, the goal is ultimately for retirement, so if you start soon enough before then, it could have a material impact on that retirement. And then there's the other thing as well, investing so you can leave something behind for the people who come after you. So from an estate planning perspective as well, it's quite powerful from there. And then the third thing, which I'll mention, and it's not necessarily why clients are coming in, but I think personally this is probably the most important reason, is that of inflation. Over the past 2 decades, I think on average, we've been seeing inflation rates of around 5 to 6% here in South Africa. Obviously, I think now is a little bit lower than that. But if we go off the average over the past 2 decades, that's 5 or 6%. So that money, let's say that you had in savings in the bank, if that was 100,000 Rand sort of this year, you get basically 5% less for that the following year, because the price of everything else has gone up by 5%, but your money sort of sitting in bank kind of just stayed there at 100,000 Rand. In practice, you will get an interest rate, but I think just for the purposes of this example, assuming there isn't one, if you're not beating inflation, the actual real value of your money is shrinking.
So we have talked about what is investing, how to actually get started, but now I want us to get into how to build an investment portfolio. But first of all, what is an investment portfolio?
Okay, so it can take many different shapes. So we mentioned the buffet earlier. So you can have some bonds in there, you can have some equities, almost a multi-asset type of portfolio. But it's really just sort of this conduit, you can call it, that holds your investments. That's essentially what it is. What I do on a day-to-day is manage equity portfolios across the board for clients. Now, it's almost entirely equity, but there will be instances where I buy some property shares for clients, or where I buy some bonds, for example, for clients. It just depends on what the client is looking for. What is that investment objective? So I think maybe it might be beneficial if I could give you a scenario, maybe on a couple of different types of clients.
Yeah.
I think the one that I deal with most often is the client who's looking for growth. So the funds that the client gives me are funds that the client doesn't necessarily need. They're not going to leverage off that funds to pay for solar or a new car or tuition or what have you. Those funds, if they were not sitting with me as an investment, they'll probably just be sitting at banks. So, that also comes back to, the amount of funds that you can invest, or, the amount of funds that you could sort of explode today, and it won't actually have too much of a negative impact on your lifestyle. So I then take those funds and I will invest in the shares that I believe will not just grow the fastest, because I want to have a skew towards companies that are really high in quality. You can sort of trust the numbers that they put out. They've got a great position where they are currently, and in 5-10 years I believe that will either remain the case or only grow. And I think a good case study for something like that is, let's say, the company Meta, Facebook, for example. They're already one of the world leaders in their field, I suppose, AI and cloud computing, etc. And in 5-10 years, that will only be reinforced. They'll only be sort of more of a leader in their industry, or at the very worst, they'll be sort of where they are now. And those are, let's say, in a nutshell, the types of companies that I'll look at to target growth for clients.
Okay.
But then on the other hand, I do have clients, and I sort of alluded to this earlier, that come in and they're like, look, Muhammad, I've got let's say, R1 million investment. I need to take 10,000 Rand as a monthly payment each and every month, and then in that instance, the focus changes completely, because capital preservation, i.e. not losing that Rand, that I mentioned earlier, becomes a little bit more important. That's sort of the main focus. So I don't really need to take growth. I need to be looking at things that will pay me a nice little income, a dividend, and not lose too much of its capital value. If that R1 million can sort of stay close to as is, then I can fund those monthly payments for as long as possible. And then it's a completely different objective. And, what goes into the portfolio is very different, but they're both sort of portfolios that I manage.
Okay. So for a young person like me, what is actually required to build a balanced portfolio investment?
Well, I would say very crudely almost, you just need access really to the internet. Companies like Easy Equities have phenomenal offerings in this respect. Personally, what I'm doing for my little goddaughter, and in many ways for myself, and the advice that I've been giving to sort of people around me, is whatever amount of money that you can save at the end of the month that you don't actually need, whether that's 50 Rand, 500 Rand, 500,000 Rand, whatever it is, you can start by looking at platforms like Easy Equities. SWIP, which is Sasfin Wealth investment platform, does something not too dissimilar from Easy Equities. You can go on these platforms, get those sort of unit trusts or ETFs, get exposure to diversified instruments, so you don't have to go and start picking stocks yourself, and get into a routine of making that deposit every single month. Once that is done, and let's say you have a bigger sort of zest or passion for it, you can start looking at individual companies. So using your sweet bowl analogy, maybe you realize that there's this cherry sweets in there that I like much better than the others, and I prefer to just be buying more of that, so look into it, see if that actually makes sense. And then you can start holding more of that specific suite or company, directly. But I would start with diversification. I would start by one of those unit trusts or ETFs, which give me access to an entire market, which is diverse. For example, you've got the NASDAQ over in the United States, which is a stock exchange, and almost all of the technology companies, your AI type companies, are on that stock exchange. So you wanted your exposure to the Nvidias of the world, that is where you would get it, which sounds great and all, but if you were to put sort of only funds into that, when the market does fall, that has a disproportionate sort of fall because it's riskier. So one has to try to go for something that is a bit more balanced. And in that respect, I would look at sort of an S&P 500 ETF, or coming back to the JSE All-Share ETF, which has done phenomenally well. You wouldn't have gone wrong with that. So the Rand has been relatively strong. And in addition to that, this whole gold rally that we've been seeing has benefited us massively, So again, the point, I think the key takeaway here is that it's not rocket science, It's the consistency and the mindset of it that is key. If you're going to be doing it, try to do it as consistently and often as possible. And then when you see drops, that isn't a reason for you to pull funds out. It's almost an opportunity to get more funds in at a sort of lower rate than you had gotten them previously. So I think mindset and consistency are absolutely key.
You mentioned diversification. So what is the importance of diversifying your investments, and why can't I just put all my eggs in one basket?
Well, I think that's the key, right? You might drop the basket, and then all of your eggs would break. So that's like really the most common sort of idiom that comes out when you hear the term diversification, and it's really just for that. If, for example, I hold some Nvidia shares, and Nvidia over the past 3 years has become the most valuable company in the entire world. If those were the only shares I had, and let's say for whatever reason, the AI market decides that they like a different company, they like Broadcom a lot better, those Nvidia shares that I've got will be impacted disproportionately high. So if I can bear the risk, then yeah, by all means go for it. It's probably not the cleverest thing to do. I think given that, Nvidia has done phenomenally well, maybe not a great example. The one I would use though, what about something like Steinhoff? If you had those shares, for the longest time, they would have done well up and until they stopped doing well, and so it's really just to protect against that downside risk of, what, you're not going to get everything right every time, but if you're only making one prediction and you get that wrong, you're in trouble. And it's very difficult to replace capital that has been lost. Once you've lost that 50%, it becomes very tough, to stomach the same company, and it may take some time for that to grow back as well. So very practically, from a diversification perspective, it's just to minimize away risk that you probably shouldn't be bearing.
Okay, no, got you. I think the last question that I'm going to ask you is the portfolio investment, right? Is this something that I can do myself? Do I need someone like you, or this is something that I can manage by myself?
I would say, to start off with, if you were just looking at those unit trusts and things like that, you probably wouldn't need me for that. But if you didn't have sort of the ability to dedicate quite a bit of time to looking into the companies and things like that, and you wanted something a little bit more comprehensive, you wanted to see actual sort of names in the portfolio, you wanted to have something, let's say, that was dollar denominated. My job is to sit and look at these companies every day. You've also got a different day today. You may not have the time to dedicate to it. So in those instances, it does make sense, the leverage of someone like myself. But I think, again, and I want to reiterate this point because I think it's important. It's not rocket science. If you consistently add it to those passive funds, which are just basically, the ETFs that I mentioned, the bowl of sweets, you're buying the market and it is already diversified. I don't think you actually need me for something like that. That can definitely be done on your own. The real tricky bit is to just move the funds from your bank account, wherever that may be, at the end of the month, to the relevant sort of platform, Easy Equity, Sasfin Wealth investment platform, what have you. That's probably the tricky bit. And then you sort of just watch it every month.
All right. Well, with that said, thank you so much for joining us and breaking down what investing really is. Really appreciate it.
Always a pleasure. Thank you.
Well, that's where we're going to give it for this episode. Until we see you next time on Breaking Down Markets, goodbye.